Welcome. My name is Sasha Moore, and we're here today with Chris Levy, SMSF expert and partner at Aquila Super, to hold the Accelerate Your SMSF Audits live webinar. But before we start, here's a little bit about Chris. Chris holds a Bachelor of Commerce from ANU. He's a chartered accountant, a registered SMSF auditor, and is recognised as an SMSF specialist auditor with the SMSF Association. Chris established Aquila Super in 1997 in response to the growing demand for an independent accounting practice that could provide specialist audit and compliance services for SMSFs, and is now responsible for audits and business development. We're holding this webinar to provide SMSF advisors, accountants and auditors with an overview of developments that will impact the profession in 2024, plus provide a deep dive refresher on a wide range of areas that are relevant to the SMSF audit process. We love questions, so we'd love to encourage you to feed in any questions that you have for Chris via the chat function, and with schedule permitting, we'll address these questions at the end of the session. That said, we have a lot of content to get through, so if we're unable to answer your questions in this session, we'll be sure to address them. We'll do a video recording of Chris's response and send you through those responses next week so you don't miss out. In these follow-up communications, you'll also receive your CPD certification, as well as some useful links, including an SMSF audit checklist, a class checklist, a BGL checklist, and so forth. In the meantime, we'll also upload into the chat function the SMSF checklist so you can access that at your convenience. So, Chris, let's get cracking. We're going to put you in the hot seat. Let's start with overview of the developments that will impact the accounting and auditing SMSF process in 2024. Over to you.
Right, thank you, Sasha, and good morning, everybody. What better time to talk about auditing stuff than on a Wednesday morning, liven up your days. As far as developments go for when you come to do the 2024 work for your clients this year. Look, truth be told, there actually isn't a lot. There haven't been big legislative changes that are going to impact it. There is obviously some stuff on the tax side, but not my wheelhouse, as it were. I guess the big one that's sort of looming in the background that may have a sort of a tangential effect on the audit files and sort of the work you're doing is this looming Section 296 tax that's got to kick in presumably 1 July next year. And the impact that it's having on the 24 work comes to the valuations. We've already been involved in discussions with these high net worth individuals, I guess you could call them, that are they're really putting their mind to this, in some cases, very, very big additional tax that they may have to pay. And the sort of strategies that are being discussed, so obviously they're going to be revaluing all of their investments sort of closer towards 30 June 25, or at least sometime in this financial year. And those valuations may potentially feed back into the 2024 financials. So, for those clients caught by this, the super tax, the valuations that are being done, you may need to be mindful of that. But look, it's like I said, it's sort of tangential. There's the sort of new rules on NALI. Again, it's more on the income tax side that accountants will have to be aware of, but it doesn't really affect the audit file too much. One aspect that has popped up a few months ago that I guess is perhaps more relevant to the audit side that will affect your clients relates to loans to members and the way the ATO are looking at it now. And I guess to some extent with some justification, they're sort of saying, well, look, in most instances, these loan to members typically come about through accidental withdrawals from the bank account, or the fund accidentally paying a credit card bill, or just errors, just mistakes that happen. Sometimes it's intentional. People are actually withdrawing money out of their funds, but in many instances it's just an accident. Not recognizing the right account on online banking, whatever it is, but they're making these mistakes, and the ATO is concerned, again, with I think some justification, that accountants are putting this veneer of respectability around it by calling it a loan to a member, and the ATO is saying, well, no, it's not. It's more like an earlier release of super benefits, and that comes with a whole bunch of additional tax and negative tax consequences for the member personally. So look, where that happens, just be mindful, that there's nothing you can do about it if a client's made this error, but there may be, maybe issues down the track, and just calling it a loan, yes, it's not ideal. There are, we have had, there was an instance actually just last week where the multi-year situation where there was money coming out of the fund, but the trustees had actually set up a borrowing facility. There's actually some documents put in place when they first started doing this, and the accountant at the time, he didn't realize it was financial assistance to members. He was just focused on in-house assets. So it was a small facility, but there was repayment schedules and interest rates and things, and it had the character of a loan. That is a loan. Still a breach of the financial assistance to members rules, but it's not an early release in our opinion. So that's okay. I mean, it's a breach, but it's not a big nasty breach. So yeah, look, those are the only real developments to be aware of in terms of changing legislation and tax office interpretations for this financial year.
Well, I think, Chris, as you rightly pointed out, the lion's share of this webinar will be looking into the refresher areas. So let's start with discussing the many and various specific parts of an audit working paper file, starting with the background.
Yeah, look, well, I guess the impetus for us doing this webinar is, I mean, just like all the previous years, but particularly last year, we're knocking out these audits, and what we're finding is that very few funds were coming to us and could be finalised without going back to yourselves and saying, "Oh, look, you're missing this document here," and or there's been no thought to this valuation here. Like there's just I guess deficiencies in the file that don't have to be there. In theory, we can even if a fund has got property, maybe business property with a related party tenant, maybe unlisted investments. There's no reason why we couldn't get a file that just comes back with no queries back to you, because let's face it, I'm sure you guys don't like us, hitting you up with all these questions or suggesting revisions to the financials. We don't like it. I'm sure the trustees don't like it. So I guess I was speaking to the other partners, it seems like the number of the funds can go right through without any problems. It's very low, 5%, 10%. And again, there's no reason for it. So I guess we sort of thought, well, if we do this presentation and perhaps just identify those areas or give some tips and say, look, this is what you need to be mindful of when you're putting the file together or you're talking to your client, so that it sort of preempts the questions that we might ask and just make the audit process go smoother. I mean, to borrow our marketing lines, we're trying to accelerate these audits for you and make it more efficient and more less painful, I guess. So yeah, that's the background there. I guess one of the other important takeaways that we're keen to convey to accountants, because some accountants are sort of aware of this, but most are not, and it's sort of the regulatory environment that we in the SMSF industry are operating in, and particularly auditors. Auditors get a much closer seat to the arena, so to speak. And what I'm talking about here is the ATO, and to be blunt, they are being very strict. They take the relevant parts of the system very seriously. And I guess I've been doing this for a long time. In initial sort of years, it was more you conduct your audit with the more of a reference to the auditing standards and things like reasonableness and common sense. Sort of that you could sort of not ignore balances, but you could kind of not put as much weight on certain things within an audit file. The terminology from my big 4 days was risk-based. If we didn't think there was a risk of something happening, we wouldn't spend much time on it. What I found over the last 5 to 10 years is that the ATO, with their way of monitoring and supervising SMSF audits and super funds generally, is much more strict than that. And it's more akin almost to like a sort of a police investigation. And I think I'll give you an example of this, just to sort of explain where I'm coming from. One aspect that confuses some accountants and trustees is why we as auditors are doing title searches every year. And I actually saw, this happened to another auditor. He did a title search on a property in the previous year's audit, and it happened to be right at the end of the year. I think it was the last week in May, and did a title search on a fund's property. Came to the next year's audit, and he decided, well, this property had been held by the fund for 20 years. What's the likelihood of it's have been sold in that last month? And so he just and from a reasonableness basis, he said, no, look, its title's okay. The ATO's position when they reviewed his file is that no, that's not acceptable. Something could have happened in that last month. So even though may have been extremely unlikely, they insist that no, you need to make sure that it definitely hasn't happened, that the title is correct as at 30 June. And that mindset, that I wouldn't call perfectionist, but that sort of very strong checking of all parts of an audit file beyond what might be reasonable, it permeates everything. It permeates valuations, the bank accounts, which I'm about to talk about. So I guess my takeaway, what I'd suggest is for accountants, just be mindful of that. That's why auditors are. To quote one of my accounting friends, that's why we're being jerks. It's because that's the environment that we're operating in. So that was. I guess that's the background. Now, in terms of one of the other things too, which again surprises accountants, is these. In the words of another accountant mate, he said, why are you obsessing over those little $100 issues here and the way the SIS Act works is that there's an obligation of auditors to report any breach of the SIS Act, even if it's $100. I myself had a situation, which the ATO was involved in, where, we had an overdraft. There was an overdraft of $100 in a $2 million fund, and in years past, the auditing standards have a thing there for trivial issues, and you can essentially ignore them. The way it works with the SIS Act is that. That's a breach. A $100 overdraft was a breach, and there is a requirement, there's an imposition on the auditor to advise the trustee of that breach. And then if it happens, and that's why we put those big paragraphs in those management letters for these, what is arguably quite trivial breaches. But then in the second year, if it happens again after we've told the trustee, look, don't do that, we are compelled to actually lodge a contravention report with the ATO to tell them that, even if it's like another $100 breach. And that's just how it works. And the ATO take that responsibility very seriously. So I guess I just sort of, apologies in advance, or for all of those your poor clients who have had to, write those letters, those paragraphs in the management letter, or had to lodge contravention reports. But that's the environment we're working in. So look, I think that's pretty much it for the background. Again, going back to, well, look, here are the parts of the audit file. I'm going to try and go through most of them and say, well, look, this is what you need to provide to us to make the audit go smoother. And I guess the first cab off the rank are the bank accounts, which are arguably very simple, most accountants, they understand the importance of the bank account. They understand the importance that the bank account, the bank statements really form the core of an audit file. The majority of the transactions are flowing through that account, and therefore the majority of where things can go wrong, i.e. compliance type breaches. Look, first rule is, look, we need all of the bank statements. with little asterisks there for the class data feeds I'll talk about in a sec. Now we have what will slow a file down is where we're not getting all of those statements. So obviously that's the first thing. Following on from that, I would say that about 10% of super funds have these tiny little almost semi-dormant bank accounts that are just there for random reasons. It might be a say credit union where the trustees have got a term deposit with a credit union, but in order to be able to do it, they have to have this little $2 bank account, that just sits there and may have been sitting there for years. In nearly all aspects, we never see bank statements for those, or at least not when we first get given the file. And what I would say to you is, with your trustees, when they're coming in, ask them for those statements. And it's annoying, and we apologise, but look, we really do need copies of the statements for those semi-dormant bank accounts, because there have been instances where there are transactions happening. Like I saw one where there's all this money in the account and no one had looked at, the previous auditor hadn't looked at, or the accountant hadn't looked at it for 5 years, and there's all this money sitting there. And so instead of $2, it was sort of $70-something thousand. So look, we need to have those. What else is there? Okay, and now going back to the data feeds. Look, the majority of accountants using BGL. Please be aware that the BGL data feeds look, they're useful, but they're useful for, like an Excel spreadsheet, in the sense that we, as auditors, we can't rely on them because to be blunt, they're subject to manipulation. They can be changed. Class is a bit different. There are specific reports that can be generated from the class software, where I believe it's called a general ledger audit trail, and we can actually see who's entered in the various transactions. And so if we can get that sort of report, then in most instances we don't need the bank statements, except for perhaps the 30 June one. So it's if you're using class, you can sort of cut back on statements, but everyone else, unfortunately, yes, look, we need all those statements. Now, before moving on to the next topic, I might just talk about the negative balances in bank accounts. And I sort of alluded to it before, with these where mistakes or whatever, they can create compliance issues, even if it's $100. And it's again, there's nothing that you as an accountant can do when your client's already, they've gone into overdraft. Or another, I wouldn't say common, but it happens a bit, is where people are just transacting incorrectly within the bank accounts. Again, they might have all of their bank accounts up online on their online sort of, net bank or whatever, and they choose the wrong bank account, and they're putting money in the super fund or taking it out, and then they correct it. Look, those, you're going to have compliance issues with those. If it's not material, then no impact on the audit opinion. But if it's over 30,000, we are compelled to report that to the ATO. It's in my experience, it's very unlikely that will lead anywhere, but we still have to tell the ATO, even if it's an error. So look, that's cash. Going sort of on a slightly related topic, interest-bearing deposits. Look, the first type of deposit would be, the term deposits. Look, again, they're very, they should be a relatively straightforward thing for us to audit. But again, it's remarkable how often a fund with term deposit, missing information can slow down the audit. And in most instances, the client will provide, the initial term deposit investment statements, but then that's it. And so, I guess if you think about it from our point of view, as auditors, we are certifying the balances at 30 June, whatever it is. And with having the initial deposit, that's good, but it doesn't actually say anything about 30 June. And so what we are looking for when we come to the audit are something else, some other documentation, and that can be post 30 June maturity statements. That very rarely comes through to us when we get the audit files. Obviously, if a term deposit hasn't matured yet, then there's nothing you can do. But many instances it has matured, and the client just thinks, well, that's next year's file, and they don't provide that. In a perfect world, you tell the clients to bring that stuff into you, and it would just make that audit go smoother. If they don't have the post 30 June maturity statements, another fallback is some banks, not a lot, but some actually do produce 30 June statements showing what the balance of the term deposit is on that date, or you can go an online thing. They can produce a screenshot, as it were, of the term deposits. Now, in the absence of all of that, there's not a lot of places we can go. In most instances, we won't qualify the audit. We may seek a declaration from the trustee, but there are instances where we do qualify the audit, where we really do have concerns about the existence of a term deposit. It might be a weird bank or something, but generally it's not an issue. That's term deposits. And the sister to term deposits are the other type of interest-bearing deposits, which are these loans to just randoms. It might be an unrelated business, an associate of the member, not a Part 8 associate, but just someone that they know is in business that needs money. It might be a loan to, say, there's unlisted trust of some sort. There's there's a whole range of different types of these sort of loans to others, mezzanine finance type things, and as you can imagine, this can be a huge risk to the auditor, because not from a compliance perspective, but from the Part A of the audit opinion, where we're signing off on the financial statements. When we do that, we are basically saying, yes, this loan is recoverable. These things are recoverable, which is crazy because we don't know anything about the borrower. No accountant or trustee expects us to go and audit that underlying borrower, and yet, if we sign off, we're taking ownership of that. And increasingly, auditors are pushing back on that. We certainly have over the last few years, and unless this other entity is perhaps listed, we'll probably qualify the audit for that. Again, not a compliance breach, but we're just basically saying, trustee, that loan to such and such, that's on you, mate. We're not vouching for it. Now, in terms of what you can provide us to accelerate the audit. Look, financial statements of, if it's an entity, having the financial statements of that entity would be useful, so we can sort of assess the recoverability of it. But at the very, very least, a signed loan agreement. If we don't get that, then it can actually turn into a compliance issue. In most instances, it's not a problem, but it can be a hassle for the trustee, especially if the loan may have happened several years earlier. But yeah, that's basically it. What else is there? Look, we may also seek a declaration from the trustee. We have all these forms on our website. So getting that will help things. Sort of getting to us, that will help things go faster. The only other thing to be aware of where you have these sort of loans is where it's actually an in-house loan. It's actually a loan to a related entity, and in that instance, we may actually need some supporting documentation for the interest rate being charged. There's entities that do that. I think CanStar do that, and sort of say, well, look, for a unsecured loan of this magnitude, this is the interest rate ranges, and just having something like that on your file. Again, it'll just make the audit go smoother because you're supporting the interest rates there. Okay, next cab off the rank, listed shares and managed funds. And look, to be blunt, these really are pretty painless for us as auditors to do. Most accounts will provide us with broker reports. If you can make sure that those are also included in the file, look, that'll be useful. We will be doing registry checks. So where we can sometimes slow down the audit is the HIN number is wrong, or the postcode's wrong. Look, I can't imagine accountants would know that sort of stuff ahead. We'll just come back and say, look, that what we used last year isn't working anymore. Can you go and find out what the trustee's done? But yeah, it is essential for us to do those registry checks. Yeah, look, apart from that, there's nothing else you really need to provide. For managed funds, again, very, very straightforward. The only issue is where the accountants provide us with the annual tax statements, which are kind of useful, not really, but what we really after are the annual statements, the statements showing the balances at the end of the year and the transactions that happened during the year. If we have those, again, very easy to audit and generally doesn't slow things down. The next one, investment portfolios. Look, these are also very straightforward. Usually, rarely do they cause speed bumps on the audit. There are, I guess, two aspects of it that can cause issues. One is where you get these 40-page reports from the fund manager, but they haven't included the cash transaction statement for the bank account that's linked to that portfolio. It's quite rare now. It used to happen all the time. You had to specifically go and ask them for it, but increasingly they are including that in the report. But I guess what I would ask is for accountants just to check that portfolio and make sure those within those reports are the cash listings. The second issue is that can arise is, I mean, look, I would say that 90% of portfolios are one of the big ones, the AMP or Commonwealth or all the big names, and we generally keep the GS007 reports, the internal audit type reports. We keep those on file, and so we can rely on those reports. But every so often we'll get this quite obscure portfolio service, and they haven't provided the trustee with that GS007 report, which means we can't rely on it until we get that. So where you do have something a bit odd, please ask the trustee to go back to their advisor or the portfolio manager and just say, look, can you send over that report? Because without it, we can't rely on any of those figures, and it can slow things down a bit. But again, generally speaking, listed shares, managed funds, investment portfolios, that's not where the problems tend to arise. Now, property, and now we're starting to get into the more problem areas, I guess. And before I go into the residential and business property issues, just getting into some generic property sort of things to be aware of. Look, I've spoken about title searches. Apologies, but we will be running title searches every year, and you don't have to do that. We'll do that. In fact, I think we're supposed to do that. But yeah, it's a cost of having a property in the fund. Some accountants and their clients get a little bit annoyed. Well, you did that last year. Why are you doing it again? The tax officer said this is what they expect, and so we'll follow that. What can also slow down audits is where it's say a new fund yourselves or it's a new property, and inevitably, I think for most jurisdictions in Australia, the name of the fund can't be on the title. So we'll need to see a declaration of trust or an acknowledgement of trust or some sort of legal document that links the property to the fund. When the ATO reviews a file, they're specifically, in my experience, they're looking for that document as well. Just having the name of the trustee company, say, is not enough. So yeah, we'll be insisting on that. And where it hasn't been done or the trustee doesn't know where it is, it can slow things down. So just be mindful of that. Another generic sort of issue we have with properties relates to where there's a limited recourse borrowing arrangement. Now, where the loan, the LRBA is new, most trustees have oodles of paperwork. The bare trust documents, the loan documents. That's all great, and that's really what we need to have on file. So it's usually not an issue. Where we'll see problems and it slows down the audit is where the borrowing arrangement has happened years in the past, and we as auditors, we need to make sure that the loan is limited recourse, where there is a valid bare trust arrangement in place, and often trustees won't have that information. We saw one about a few years ago, and the borrowing arrangement had been going on for 8 or 9 years. And when we insisted on a documentation, it absolutely wasn't a limited recourse borrowing. It was just the bank doing a personal loan to the members, who then on-lent it to the fund. There was the whole legal structure that's required. It just didn't exist, and no one had picked it up. The ATO expects auditors to have on their files those original documents, and they can be problematic. Look, if I can't find it, I don't know what the solution is. Maybe going back to the original bank, but just be aware that without having that documentation, it will slow the audit down. And look, the final point I want to make about general property relates to where a property is held in partnership with other parties. It's not common, but it does happen. And look, it's there's nothing wrong with that. However, in half the instances I see, it's almost the property partnership's almost run as its own little entity, and has its own bank account for receiving rent, paying expenses. Makes a lot of sense. I can't remember the last time where a super fund was involved in a partnership like this, where the bank statements for that partnership were provided to us. We always have to go back and ask for it. And look, the reasoning behind us needing it is, it's fairly straightforward. A partnership isn't its own little entity. The fund has a proportional direct interest in that bank account. And so when that bank account goes negative, that's an overdraft of the fund. That's a breach that the fund has incurred. And so we need it. And plus, of course, we also need to just monitor what's happening with the transactions within that bank account. And I've seen one where at the start of the year, all this money was taken out and given to the family trust, and then there was kind of like a balancing out that happened at towards the end of the year. And the family trust actually paid money back, which, again, because of that proportional direct interest, it's an effective loan or in-house loan to the family trust from the fund. And just looking at the financial statements isn't enough. So yeah, look, if you do have one of these, please ask the trustees to also provide those bank statements, even if it's a bit, problematic. So yeah, look, that's general property. Moving more specifically into residential properties. Look, I think most accountants and trustees are aware, we do need to get those appraised. The valuations is sort of the key area that can cause problems. I would actually say most accountants and trustees have really gotten on top of this. They recognise the the need for supporting information, and that can be there's the online stuff, the core logic, RP data. That can be useful. Other online stuff, realestate.com, domain.com, those sorts of things, and an agent appraisal. Now, accountants ask us, well, do we need an agent appraisal, with comparatives? Look, not necessarily. If the data from the online stuff's good enough, then we'll accept that. And when I say good enough, the ATO generally accepts. They've got these confidence levels that go onto the online stuff, and it's the ATO generally accepts a high or medium high. When it's lower than that, and in my experience, there's not a lot that sits that level, but what you can do, and again, it's sort of this extra layer of work accountants might have to sort of do, is sit down with a trustee maybe at the start of the job and say, well, look, here's some valuation information. Can you firm it up? And what will tend to happen is this online data will have it will have all the comparative sales around, say, an area. And in my experience, the trustees will be able to say, well, look, that property doesn't apply because it's corner block, or this one doesn't apply because it's been condemned, or whatever. And they can actually find up the data, and that's useful. So I think the combination between online data and trustees, they write a few sentences, maybe a paragraph, just justifying what the value is. That's probably enough for residential properties. Occasionally it's not, and we'll have to go back, but in my experience, trustees generally know what they, they know what it's worth, and they can provide a good argument based on this other information for why the value is what it is. But yeah, look, if you can, again, most accountants provide the right information at the start of the job. One thing I will say, and I guess is more of a general property rule. Look, what the ATO recently sent out, they did a sort of a mail campaign thing, and they identified those super funds that where property has not moved for 3 years. That seems to be their red line, as it were. If they don't see property moving for 3 years, they have a real prima facie concern that the trustees aren't taking their valuation responsibilities seriously. So I've noticed, I guess, the good accountants are making sure that those properties move in some way every single year. So keep that at the back of your mind, that you should, best practice is to do that as well. And it should be a basis for it, as in, like I said, the online research. So, yeah, look, that's basically it for valuations. Do we need tenancy agreements? Look, not necessarily. If we have rental statements that show the tenant, look, that's fine. Holiday homes are a little bit different. Look, I mean, if you can provide rental statements that show that the trustee hasn't been staying there, that'd be ideal, because I mean, that's the concern. The risk is that the trustees are using their own property. Anything you can provide that that proves that they weren't will be useful. In those instances, we probably always, well, specifically for holiday homes, but all property, we ask trustees to sign these declarations stating that they haven't stayed in the property. So yeah, so that's residential property. Now business property, I guess this is one of the main areas which can delay or slow down the audit process. Not because they're particularly complicated, but so many funds have them. The big issue with business property are the valuations of those properties. And look, unlike residential, business property for the most part is very specialised. It might be a bakery in a regional area, or a specific type of factory somewhere else. Office blocks, they can be a little bit more generic, and you can find online information easier. But generally speaking, best practice is, yes, you will need to get a detailed valuation with comparatives every 3 years. What the better firms seem to be settling on is doing a valuation sort of in the middle of a financial year, so that value can be used for the prior year's audit or financials, and for the year coming up. And so, it's sort of covering off 2 bases. And then in the intermediate year, using online research, maybe finding their own comparative or sales of comparative properties, general movements in the area, so industrial movements, industrial properties in, say, West Sydney. There's enough of that information out there, but they can make changes to that valuation figure until the next valuation rolls around. But what I've found is, in many instances, trustees still aren't doing this valuation as often as they should. They're not updating the value every year. They may have had a valuation 2 or 3 years ago. Look, again, coming back to the ATO's position, they're very strict on this. They expect that trustees will be reassessing the values every year. So we will, and we as auditors will push back if we just don't see any effort being made. Now, the other thing that can slow things down is leases. There's a higher risk that well, from the ATO's point of view, that there might be like a related tenant, and we need proof that a related tenant isn't actually leasing the property. And the way we do that is by asking for the lease, or at least an extract of a lease that shows the parties and terms. And so we can say, oh, look, this tenant here clearly isn't connected to that, to the trustees. Is it definitive? No, but it's fairly solid evidence. So we do seek leases. If a lease is expired, we'll go back and ask for a new one. That can slow things down. Where a lease has finished, but there's an option, again, we'll be seeking the the copy of the written sort of rollover. But again, like I said, those are the things that can sort of slow things down. Where you have a related tenant, now look, obviously there's a higher compliance risk profile, in those scenarios, and the type of information we need is obviously higher. Again, we need a copy of a lease, but where there's been a market reset, sort of at the start of a lease, or sort of a execution of an option, we will need and then they need to provide supporting information for that lease. Now, it doesn't have to be a agent's rental appraisal. It can be. A lot of clients do that. They just sort of accept that, and they move the monthly lease payments based upon whatever the agent says. But in other instances, the tenant can actually find sort of advertised rates or examples, maybe say in the same building or the next building over. Like I said, if it works for offices, factories not so much, but they can provide other information again to support that, to be able to demonstrate that the rent that they're paying is market. In my experience, we're not usually provided this, and we'll come back to the accountant and we'll say, look, we need something, we need to have this, and it just slows things down if we don't get that. Okay, look, I think that's pretty much it for business property. The only other thing I'd say is when it comes to rural property, look, it's a similar sorts of issues. We'll need a copy of a lease, but the valuation of rural properties, look, by all means you can get a valuation, but we've sort of noticed a lot more lately is that sometimes the accountant or the trustee themselves will actually provide evidence of acreage rates, or how much they've sold for, how much they what the adjustment rate is, and there is this data actually available. And if they can provide it, look, that can be a substitute for full-on pastoral agent reports. But look, again, if we get these audit files and they're not there, we will seek that. But yeah, there's an option there for those clients with rural properties to do it themselves if they can get this information. Okay, then onto my favourite area, and this is another one that really does slow things down, and one of the main areas, and that's unlisted investments. Look, this is a high risk area for audits. Not just on the valuation side, but just the veracity of the financial statement side, the Part A side of the audit opinion. Because let's face it, we're not auditing these entities. We don't know if they're a going concern. We don't know what you really have to get in the weeds to come up with a proper value. So inherently they are high risk for auditors. So what do you need to provide us? I guess in the first instance, with an eye to the asset verification aspect of the audit, look, having the fund mentioned in the financial statements and the equity section is good, but what we're really looking for are the unit certificates for a trust or the shares. We need to, if the fund's saying, yeah, look, we own 100,000 in this investment, we need to have evidence of that. And that I found in my experience that can be a little bit tricky. Some of these entities, particularly the smaller type unlisted entities, then they don't issue them for some reason. It's more sort of, I wouldn't say handshake, but it's a bit more loose in terms of the documentation side of things. But yeah, look, we will be asking for those. And now the big issue are the valuations. Look, I'm not going to spend a huge amount of time on the different valuation techniques. Most accountants can come up with some figures, some arguments for what it can be. I think one of the problem areas is that to many accountants, it falls into the too hard basket, and they just don't put any effort into it. And they say, oh, well, we got a valuation 3 years ago and not much has happened, or we're just going to keep it at cost. Look, I can't emphasize enough, the ATO no longer accepts that now. They do expect that trustees will put their mind to coming up with a valuation every year. Now, as auditors, look, in addition to those unit certificates, we'll be seeking the financial statements every year. for those unlisted investments, and you can use those to help come up with a valuation figure. Look, if there's been recent capital raises or sales between unrelated parties, that's useful. But again, we'll need to be provided details of those transactions. What can work is, I've seen increasingly the investment manager, for want of a better word, will do a sort of a generic email or a document provided to the various investors, basically. Providing sort of like an investor update, as it were, saying, look, this is what's happened during the year, and here's a valuation for at the end of the year. And I would encourage those trustees that invest in these unlisted investments to go back to the manager and say, look, can you provide this? Can you give some guidance? It may be that there's a property sitting in this unlisted investment, and they may have got a valuation for bank purposes or whatever. Again, that can flow through. That's useful information. In the absence of that, you've got to rely on capitalization of earnings. Look, like I said, I don't want to spend a lot of time on that, but something needs to be done. And as I said, in many instances, it's not. And I have to go back and say, look, redo it. One of the other partners just commented the other day that there was an investment that had been sat there for 6 years at $100,000, and when they actually did a proper analysis, it skyrocketed to sort of over 800,000. And I guess that sort of reinforces why the ATO focuses on that. And look, I guess what I'd say as well is that if you are faced with something like this, and it applies to like not just unlisted investments, but some of the other things I've said, the business property and valuations and other stuff. Don't feel shy about approaching your audit partner anytime other than at the end of the job when it's done. Like if a trustee's about to come in or you're in the middle of it, and you're not sure, come and talk to us, and we can provide guidance on what we would be happy with. In terms of methodologies and things and solutions to tricky issues. As the carpenters say, measure twice, cut once. And so we're happy to help, not have to make you cut 2 or 3 times and redo financials and things like that. So, yeah. Now, before I go to the next one, I just want to talk about semi-related trusts. And these are these sort of these unit trusts where there's only a handful of investors. They're not related. The trust is not a Part 8 associate of the fund, but maybe the fund and the members owns 25% of it. And the ATO, in my experience, it seems like they have a high A risk profile, not surprisingly. And as a consequence, we as auditors have to do a little bit more digging into that. Now, the way that manifests is, at the very least, we'll be wanting financial statements for those trusts. Where there's a property involved, we may actually see, we'll probably do a title search, but we may also seek property valuation for that, like actually seeing the valuation. And this could be problematic. It's all I can say is that as I said, the ATO, it's a higher risk investment, and the ATO place higher expectations on the auditor. So we need that additional information. For 1322C unit trust, those special investment vehicles, obviously, they've got those special rules about not investing in related entities and no borrowings and whatnot. In those instances, look, we'll be asking for the bank statements for that entity, and the reasoning behind that is because if they go into overdraft, it's the 1322C unit trust stops being one of those. It's actually failed the rules and becomes tainted with all sorts of compliance issues. But without actually, opening the bonnet and really getting in there and looking at the activities of the unit trust, we won't know. ATO is aware of that, and they expect auditors to do that. And it may seem a bit onerous on, the trustees' part. They may say, well, look, the other investors may not be happy with this. Look, I don't know what to say. We are expected to look at in greater detail. So yeah, if you could provide the bank statements for those unit trusts, it'll be useful, and property valuations and all that sort of stuff. So yeah, just be mindful. We will need to dig a bit deeper into those type of trusts. Okay, look, I think that's it for those trusts. Very quickly, crypto and bullion, another favorite topic for auditors. Look, there's not much to really say about crypto. It can be a hugely risky investment for us as auditors. They, just by their very nature, most auditors will generally qualify if it's a material amount, because they're very difficult to prove, with one exception. Where your client is using a platform, such as, say, Coinbase, what we've found inevitably is none of these platforms are audited. None of them have a GS007 report. And so for all intents and purposes, as audit evidence, they're not great. They don't, it's nice, it's good for valuation purposes, but it's not great for asset verification purposes. And so in that instance, we generally, we'll qualify. If it's a material balance in crypto, we'll qualify. Now, the exception to that, and we've actually had more success with crypto held on a cold wallet, is where your client can provide the key to that, where we can actually look it up on the systems. There's lots of websites where you can do this, and I must admit, this is beyond me. We have crypto specialists in the firm, but they can go in and we can actually provide evidence, similar to sort of like a share registry as well, and prove that these crypto balances exists. And does it directly link to the fund? No, it doesn't go to that length, but there's other paperwork that can be done. So if your client does have crypto, try and obtain that key from them so that we can verify. Otherwise, it just, look, we just sort of shrug and just do a qualification of some sort. Now, onto as far as bullion goes, bullion can also be quite problematic. If it's stored at a vault somewhere externally, that's fine. That's not an issue. We obviously will need a year-end statement, and that's actually very easy for us. Where it's not kept, if it's kept in their own house, and this seems to be more common. I think it's sort of the end of the world types, and they trust gold and they want to keep it there. Look, again, that's okay. What we will need though is a photo, a dated photo of the bullion. Ideally like a current newspaper, so we know. But basically we need to prove that it exists. Again, in my experience, most trustees don't volunteer this when it comes to the year-end accounts, and it can be a little bit annoying, and they pull it all out of their safe and all that sort of thing. So again, if you can get that before the job comes to us, it'll just make that go a bit smoother. All right, so that's the crypto bullion. Look, just very quickly on a few other little areas. Contributions. I just want to make a reminder that even though the work test has sort of gone, it hasn't gone for member personal deductible contributions. It still applies to that, and we've seen instances where accountants forget. They think it's just completely gone out the window. In most instances, the member that over 67 has made those contributions, they are generally working. They will meet the work test, but it's sort of slipped the mind of the accountant. So, first instance, be mindful of that. And B, when it comes to the audit file, if you can provide one of those work test declarations from the trustee, just saying yes, look, they have met the work test. Look, that'll be useful. What else? Corporate trustees, again, sort of similar to title searches, there is an expectation by the ATO that we review the details of the corporate trustee every year. And so as a consequence of that, we will be asking, and most accountants provide this, or at least 50%, the ASIC statement, the annual ASIC statement, or a corporate search. Now, in a perfect world, that's post 30 June, but it doesn't always work out like that. The statement may be, say, December 23 for the 24. And look, that's okay. We can jump online. We'll check if there's any changes. I mean, if there are changes, well, that's a different. Have to do a proper search. But what I'd be asking though is that for your audit files, if you can ask the trustees where they have a corporate trustee to provide the annual ASIC statement, that would help speed things along. What else? Investment strategies. I guess what we have found, I mean, most clients are pretty good, and they've got proper investment strategies, and they update them regularly. But we have there are instances where there's a drastic change. A prime example is where people sell a property under a limited recourse borrowing, and their previous strategy had lots of paragraphs related to the risks of borrowing, and they're going to have most of their investments in the property. And if there is a change and they're not intending to go back to another property, that strategy needs to be updated. So look, have a look at the strategies before you send it to us, and if the fund has had a drastic change in its investment mix, and it may need updating. If it hasn't, again, we'll push back and say, look, you need to, provide us an updated one. For that, look, wind up of funds. This seems to be causing a lot of accountants grief when it happens. I guess in the first instance, I'm come and talk to us about it, because everyone seems a bit different, depending on whether they're about to roll money out using SuperStream or pay it out. But generally, we understand the dilemma that accountants face, in that they want to close the bank account, but they can't close the bank account because they need it for tax or rollovers or whatever, and so they're sort of chasing their tail. The summary is that even though the bank account's still technically open, we accept it where the balance sheet's sort of effectively written down to zero through the use of outstanding checks and deposits, essentially. And again, if you don't do that sort of system, you can never really close it. But look, come and talk to us if you're not sure about it, because everyone's a little bit different. Look, and I think that's it. I spoke about the audit reports and qualifications, and how if you get a breach in 1 year, we are compelled to do a contravention report in the second year, even if it's trivial. And I guess that's sort of the only thing to be aware of with that side of it. But look, I think that's basically it. I haven't covered everything. There's always little things. There's some weird investment class I haven't spoken about, or unique characteristics of say properties or unlisted investments. But that's the bulk of it. I think if you focus on what I've spoken about, hopefully you can take something from what I've said and just make life better for me, but also better for yourself and for your clients. So yeah, that's it.
Well, I think you've done an extraordinary job, Chris. That was a marathon effort to cover a lot of content in a very short period of time. We have had some questions come through, so we'll just maybe throw to one or two of those questions, and then, as I said, we'll go through the rest of them separately. So we've had a question from Sam saying, winding up funds, what do you expect when there is a death of the member and the fund is in the hand of an executor?
Right. Well, okay. So there's several parts to that. I mean, I guess in the first instance, where there's a corporate trustee, those executives need to be appointed as directors. And then they can sort of act to wind up the fund. In terms of the accounting side of it, I sort of covered that. You basically get everything down to zero. What else is there? I guess in terms of making the decisions as to the payment of the benefits. Well, once we as auditors, we will be looking for extracts of the will that appoints the legal personal representative. But I don't know. I think that's basically it. Whether wind up of a fund, whether it's on the death of a member or not, it's very similar. It's just that there's those extra steps that the legal personal representative has to do to get themselves formally appointed to be able to make legally valid decisions.
Okay, thank you. And we'll just throw to one more question. An anonymous attendee has asked, with an unlisted company investment valuation, if the trustees are unable to provide any kind of basis or documents for valuation except for financials, the investment is $100,000, which is 60% of total assets of the super fund. But while reviewing the company financial, it appears it's only 3%. What could be the possible audit action as the trustee does not have the controlling interest and the valuation remains unchanged in their super financials?
Yeah. Look, and this is a problem. This happens all the time, and particularly it's a problem for startups. They're not making money; they're bleeding money, but in IT world, that doesn't matter. It's based on a multiple of your revenue. So you get this like crazy valuations and things, or the startup's just not at the stage yet where you can get a valuation. There is a category of unlisted investments that simply cannot be valued. I guess in the first instance, what it would mean is that we would say, well, Part A qualification. We as auditors cannot put our name next to a value, and trustees accept that. The more significant issue is that it can be a breach. If the ATO's position, again with this very sort of strict approach they're taking, is that if you can't demonstrate or support the value you've put down in your financials, it's a breach. And so, I've done plenty of those, and other auditors have as well, that where you can't provide supporting information for a value, it's just kept at cost because no one knows. We will qualify under Part B and lodge a contravention report and say, look, we just don't know. We don't know what the value is. Will the ATO do anything about it? Look, unlikely if they're told all of the facts. I mean, they may, but in my experience, they generally don't. I think they recognise that for some of these investments, it's just impossible to get a valuation.
Okay, well, thank you so much, Chris. Really appreciate your thoughts and insights. I hope you've got a more relaxed rest of the day, because it's been very, very high energy and very insightful. So thank you so much. Thank you for everyone who attended today. We hope you found it insightful, and we'll look forward to seeing you next time. Goodbye.
All right, thanks. Bye.